Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Friday, March 19th, 2021. I wanted to do this one before the market closes today. Get the video out to you guys, just give you my thoughts on where I think we're at and where we may go from here. So I'm going to start out with the equity markets and touch on a few of the other things I've covered lately, such as crude oil and gold, any related trades to those. All right, so this is the SPY, the S&P 500. And you can see, same story. We've been diverging. We had a break of the primary trend line back here. That's the primary uptrend line off the March lows. Enough reactions to validate it. Breakdown back test, roll over, and we put in a marginal new high. Talk about that quite often. When you have these divergences and you start a correction, sometimes that's it. That's the top. Other times you go on and extend the divergences. And typically, not always, but typically bigger divergences equate to a bigger drop, or once the trend reversal finally comes. That's what divergences do. They don't guarantee a trend reversal, but more often than not, you do see a trend reversal after you have divergences. Only time you really don't is when the divergences are burned through, meaning the indicators like the PPO down here and the RSI get up and they take out those previous highs, and then you no longer have the divergence. So that's that. As far as the technical levels, we still have that 387, 80-ish support right here on SPY, and that's what we're tested. We tested today almost perfectly at the lows. That was support right here. We broke it, kind of danced around on it. Pretty much it was resistance. We had a few slight pops over above it, from below I should say, came back above, and the fact that it's been trading through makes it a little less valid, a little, not as significant, but it's still, I think, worth watching, because again, it was a pretty well-defined level back there, and it's also today's lows, so we'll watch that next week. A move down below that I think will open up another leg down. I'm still leaning that way. Nothing's changed, but you cannot rule out that the drop we had, especially in the tech sector recently, you can't rule out that it was anything more than just a correction in the road to new highs. Again, I'm not going off that right now because there's a lot of evidence I've talked about for weeks, even months now, that have been building in the chart, some extremes, excesses, and now we're starting to finally get those sell signals. For a long time, I can talk a bearish talk or a bullish talk on a security, an index, commodity, the market, looking for a turn when there's a strong trend. But that's one thing to talk about expecting reversal. Finally, you need to get those sell signals, and we've started to get some of those. I'm going to go over those today. So that's it. Again, the S&P 500's held up relatively well, and this is more of the stock market than the NASDAQ 100. I like to trade the NASDAQ 100 because you get more juice. In other words, if you get the call right, it tends to go up more in bullish trends and down more in bearish trends. Why? Well, because it's not as diversified. It's mostly tech. It's over 50% technology, tech or higher growth companies than say utilities, things that drag or hold back the S&P 500 even during a bull market, because utility stocks may go up, but they're not going to grow as fast as tech companies. Same with the defensive issue stocks, REITs, and all that, which the SPY is. SPY is much more balanced out. So those same things that make it a probably a better index for most buy and hold investors, because those other sectors will tend to also help support the S&P 500 during a correction, at least to some extent. They also tend to hold it back to the upside. So that's one reason you see a lot of analysis on QQQ and even the small caps, which are, again, you get more bang for your buck if you get the trend correct, because small companies have a faster growth rate than large companies, which are at that mature stage or close to it. Okay, so that's it. We'll just watch next week a break of today's lows. As I said, I think will bring us down to that 370.45 on QQQ. Oh, and before I leave the SPY, I wanted to show you one thing. I talk about this quite often. Down here I have a line. I'm going to brighten it up for you. I talk about one of my favorite trend indicators, and I like it because it's so simple yet effective. You always have to give points to an indicator based on simplicity. You'll take, all other things being equal, you want the more simple indicator versus a more complex one. But in this one, for how simple it is, very effective, and that is I like to use the PPO signal line. That's the white line, which is always the last of the two to cross. And quite often it's the zero line, that dash line. If you put up a PPO indicator, and if you don't have that, use a MACD. It'll be very similar. They're close cousins, the PPO and the MACD. And then I'll study a security. I quite often look at the zero line, but then when I look at any particular security, I say, okay, where does that white line? And I use the signal line, being it's the last of two to cross. That helps prevent or minimize whipsaw signals because it's it's the moving average onto the PPO. And so in this case, that red line, which is at about negative 0.64, you can see pretty much over the years, that's where SPY, that white line defines a bullish trend. And when it crosses below, like you had a cross right here, that was early on in that big drop into what I call the COVID lows back in March of last year. And you can roll back and go back for years and you'll see the same thing. Bullish trend. You want to be long the S&P 500 when it's above there. And then if you remember, there was a big correction in the last fourth quarter of 2018, and that trend indicator caught most of it. And the way it works is when that white line goes below, the trend is bearish. And then the line often acts as support and resistance when you're above or below it. So see, in this case, you pulled back, successful test. Pulled back, successful test. There was one little whipsaw there, but once you broke it, that line then becomes resistance, and that kept the trend bearish. So where I'm going is the S&P is comfortably above that trend indicator. And as I've said quite a bit recently, it's been the stronger of the large cap indexes, which overall bodes well for the economy. However, you have to put a big weighting on QQQ because tech, although it's not nearly as top heavy in the S&P 500, it is still the heaviest index, the highest weighted index at over a quarter, 1/4 of the weighting of the S&P 500. And those are, our market leaders, our high growth companies, such as Apple, Microsoft, Alphabet, the big FANG stocks. So here it is, QQQ. We'll start out with that trend indicator since I was just talking about it. And you can see the same thing. There's a bullish trend in QQQ. We crossed right there, and all along here it said bearish trend. That was that big drop in the fourth quarter of 2018. And since then, pretty much that level's acted as support until right there, early on back in early March, it gave us a sell signal and didn't go back bullish to right here, right after the correction was over. And since then, we tested it, and recently broke it. Now, this may prove to be a whipsaw. We had a little whipsaw right here, but you can see when we go in really tight, what's happening. Remember, the PPO is a momentum indicator, and when it's going up, the momentum in the market is up, and when it's going down, the momentum is down, obviously. And so we had a correction. We had what I suspect, it's hard to say it with the strongest degree of conviction, but I still suspect this is a counter trend rally with another leg down to come. And so we started to turn the indicators up, but just recently it started to turn back down. And so if we get this, we're not going to know today. This is going to be at least till next week. But if we start to go down here, we'll put this indicator squarely into bearish territory. So that's something I'll be watching. And as far as price levels go, here's a zoom in on QQQ, kind of to recap everything since it's the end of the week. I'll do more of a recap in this one. You had the primary uptrend line off the March lows, very, very well defined in QQQ. By that I mean you had all these reactions back here, at the March lows, then a bunch of other reactions recently, finally a breakdown. And so again, say what you want about where you think the market's going, but it's hard to argue. You cannot argue that we're not currently, or at least this wasn't a correction, we're still in that now. Where we're at, and this is interesting, I mentioned a few days ago we hit, this was a big level here, the top of this trading range right here. We take that line across, it's about 325-ish or so, 324, and that was resistance. We hit it, we failed, then we broke this minor uptrend line, and now we're back to the bottom again of this same trading range. And so that's it. If we go much lower, we break support, I think we'll make another run down at my 297 target, which was already hit once. And if we get there, I think we'll take it out and go down to 283. And then we'll be able to say with certainty, of course it'll be in hindsight, that this was a counter trend rally and a great time to short. said other day, it's objective to short there. Anytime you have rally back into resistance, if you can make a case that it may be a rally, a counter-trend rally, a counter-trend bounce, you can always make an objective case to short. And the thing is, you just keep your stops tight. So either way, that's where we're at. We probably won't know until next week whether we break to the downside of this range or if this correction, remember this was 12+%, better than a 12% drop in the NASDAQ 100. And that's certainly enough that was, it meets the technical definition of a correction, a drop of 10% or more. And maybe it was enough to alleviate the excessive bullishness that we had recently, as evidenced by all these sentiment indicators, the put to call ratio and everything like that. Again, I suspect this is probably a counter-trend bounce, but you just can't bet the farm on it at this point in time. But that's what I favor. And and you look at this pullback, we didn't even hit the 200-day moving averages. You probably can't see them on the video, but I have the intersecting 200-day simple and exponential moving averages come in right now, right here. So I think if you want to see or know what I think might happen next week, and if it does, it would be fast in the next week or so, is another leg down, probably undercut those 200 days because they come in right here above my 283 target. Undercut those intraday or intra-week, hit that 283 target, and then the buyers step in and park it at least temporarily back above or on those 200 days. Rarely do you just slice right through the 200-day like it's not there. Those are big moving averages. And again, I like to use both the exponential and the simple. Why? Because this is my preference for the tech stocks, but a lot of people do trade using the simple. And hey, if buyers are stepping in at the simple moving average, I need to know that and be prepared. And it's all the better when they both come in together, because you have now two moving averages that a lot of traders are watching and trading off of. So that would be a scenario if we do next week. Let's say start the week lower, gap down, or whatever we do, whether we go up and then down, that would be your scenario. And again, I suspect we'd probably slice through it. Maybe a little, buyers might step in on the initial tag, and then we'll just have to go from there. If I'm wrong on all that and we go up, well, it's very simple. We already tested the top of that range once, the 324, we'll call it 325 level, actually twice. If we pop it, there's not a lot of resistance. You have a little bit of gap resistance there just above, and then there's the previous all-time high on QQQ. Would it be an all-in long moment? For me, no. Why? Because you're still going to have big negative divergence. So divergence continues to build. But near term, if you pop there, it's going to increase the odds that the market might want to make a run at and a break, and may probably be, in my opinion, a marginal new high. Meaning slightly above the other highs before the divergence is set in for another drop. IWM, no change since my last update. I still favor a pullback to the primary uptrend line off the March lows. The S&P 500 and NASDAQ 100 did break it. The large caps did. Small caps were so far ahead, they have a lot more air beneath them to come down. So that would be, I think, a very, very logical and likely target should we take another leg down here, which I suspect in the small caps, and that still gives us plenty of room, until we get there, probably another 8% or more just to come in and test the line. And then depending on how things look, if and when we get there, I'll give you my thoughts on, will we have a bounce and how will it look. A lot goes into it at that time. In fact, I need to put one other horizontal support level there. You have a couple reaction lows right there. So and it comes in together. So there's a nice target if you're looking for a price target. Right about 205 should do the trick on the small caps. Let's see. I already gave you charts. I believe I did this morning in the NASDAQ 100. This is a 60-minute chart, or NASDAQ 100 futures NQ. Wash, rinse, repeat stuff. You look for these divergent highs during an uptrend, and then that usually gives you the trend reversal, and that usually ends with, not always, but often with the divergent low, and that means positive divergence like you had there. Rallied up, divergent high, breakdown back test, moving lower, hit that 12,704 support yesterday, hit it again today. Again, as I said this morning, I'll give you my outlook. I'll give you downside targets where I think we're going to go if and when those levels are broken. So they haven't been taken out yet. So that is, same thing I said this morning. We need to see the indexes The small caps, particularly the large caps, the S&P 500, ES, NQ, QQQ, all take out yesterday's lows and today's lows, and that should open the door for another leg down. And I already gave you my thoughts. At that point, you really zoom back out, or I would, to the QQQ daily chart and look at those longer-term swing targets I gave you there. Because if that happens, I think it's going to be quick. I think what happened that Powell pumped the other day, the FOMC announcement at 2 p.m. on Wednesday, markets ripped, but then that was all faded. So a lot of buyers got sucked into that, the Fed's dovish comments, and the fact that they couldn't build on it, it simply tells me the market's always, at the core, it's all about supply and demand. If you have more buyers at any given point in time on any security, it's going to go up. If you have more sellers, prices will go down. So, obviously they bought that day, and I'm sure the algos had a lot to do with it. They parse through the Fed statements immediately, and they fire off buy programs based on certain words and phrases that are in the statement before humans can even, read through it. So that was part of it. And then buying begets more buying in this day and age of high frequency trading. That's how it works. HFT, those programs step in front of buy orders, and they step in front of sell orders, and they tend to exacerbate, sharp sell-offs and sharp rallies. So either way, what I'm getting at, that was all faded, which is near-term bearish, and again, that as I said yesterday, that to me increases the odds that we're going to have another leg down here, but it's still not baked in the cake by any means, and it's again that simple. We need to take out those recent lows. And here's RTY. The RTY is the Russell 2000 small cap ETF. There was a little divergence at today's low. What happened is we had a whipsaw signal. We hit my first target, which I've had laid out here for a while on RTY, the small caps. You had a sell signal here on the break of that bearish rising wedge uptrend line. We're in a downtrend. Went on to hit my first target, consolidate on it, briefly spiked below, but snapped right back up. That might even been on the same candle. So I technically, yeah, well, no, looks like we had a red candle. I have to flip over to candlesticks. They're on bars right there. Right about on it. So you can see, and right about at those recent lows. See those lows right there? And so that's what it held so far. So those were intra-period or intra-candle dips below. So we pretty much held support. Again, I'm referring to these previous reaction lows right here, here. See where the body of these two candles remained above that level, popped up, but we're still very much in a downtrend, near-term downtrend. Not long-term, but near-term. Make no mistake about it. Downtrend is any security making a series of lower highs and lower lows. That's all we've done so far. If and when we take out these recent highs right here, sure, that's going to call that any downtrend into question and say that this may have just been a correction, that the correction is over, but not my current view at this point in time. I do think we'll get another leg down and likely hit my second target, and I think it'll happen next week. And why do I think that? Well, stocks tend to fall faster than they rise. Corrections, you can get a correction, and that was just really a pullback, but corrections usually start to snowball, especially at this point. Again, going back to let's look at that XBI chart I gave you today, for example. I had a couple subscribers ask about that, and when I look at this and I turn off all the lines, I put a detailed post up, 3 different charts, 3 different views, but when I look at it just from a simple price perspective, this was a pretty big correction. This was, let me just tell you, measuring from that high on February 9th, I think it was, down to the low right here. That was a drop of over 26% in the biotech. So, and it was, as you can see, fairly straight down. So usually corrective waves, if you're an Elliott waiver, you know that you're going to have at least an ABC wave, ABC type correction. That's a corrective wave is usually a three-way pattern, A, B up, and C down. And so this was just a drop, and when it's 26%, that's usually more than just a run-of-the-mill. These are just run-of-the-mill pullbacks within an uptrend. This was a healthy correction, obviously 26%, and you can see where it stopped. Remember, I talked about the importance of the 200-day moving averages. I think you can see it in the video here. I'll make sure you can. Turn the brightness up, and you can see where pullbacks to XBI are often bought up. So I made the case in that post this morning There it is. That was a perfect tag of the 200 there, prior one, and the recent one there. We were hitting it here, dancing on it, and then the 200 SMA just below gave it up right there. That candle, we broke below both the 200-day simple and exponential, and boom, then you had a lot more selling, and you recovered it here, and that was bullish. So you get the point. It acts as support when you're above it and resistance when below. Again, you want to play glass half full. If you believe the market's going a lot higher this year, it'll probably take the biotechs up with it. And this might be like this drop back into the March lows, the last time the RSI hit the 60 level. But the point I was trying to make is where we might be in the correction, with these waves and the first leg down. And when you look at the S&P 500, you still have this other high right here, but as I said, with these divergences, that's how it sometimes plays out. So this one, really, the correction in the S&P wouldn't be starting technically until, if we're going to go down next week, until Wednesday of this week, and that would have ended. And I'll tell you, I've seen a lot of inflection points around FOMC meetings, and again, that was Wednesday. That is where the S&P put in that all-time high. So it'll be interesting to see where we go from here. One thing to note are Treasury bonds. I wanted to do an update there. TLT. This is the long bond, 20 to 30 year bonds right there. And really what I'm watching more so are the long bond yields. And that's TYX. I'll go to this weekly chart. And we've seen just a tremendous rise in yields. And we're still at that resistance level I pointed out a few weeks ago here on this weekly chart. We're just a hair above it. For all intents and purposes, we're right on it right now, and that's about the 24.16 level. So we've rallied into resistance with treasuries. I'm still favoring a rally in TLT, which is a pullback in yields. I still think that'll happen, and that would mesh with a correction in the stock market. If we get another leg down, it'll probably be more impulsive than the selling we just saw over the last couple of weeks. And remember, the S&P 500 was hardly phased. It was more of a isolated to the NASDAQ 100 and big tech. So if we get a broad-based sell-off, that's when the institutions will scramble and usually move money into treasuries as a flight to safety bid, and that would mesh with a pullback to this primary uptrend line in TYX, and that means yields down and bonds up. So ZB, your treasury bond futures, or that's the 30-year. ZN is the 10-year futures, or you trade the ETFs, which are TLT for the 30-year, and then IEF for the 10-year, and that's what they look like. And TNX is the 10-year treasury yield. Now, all right, so you can see here, TNX, the 10-year, already broke above big resistance. That was big, to me, very important critical support right here. All those tags, and we broke it there during that COVID meltdown. There was a flight into treasury bonds. You're seeing a drop in yields. Remember, that's strong buying of treasury bonds. Nobody knew what to do. Everyone thought the world was coming to an end, so they flocked to safety, and this is a exit out of that. And what I think it's more the fact that Powell is completely ignoring or dismissive of the fact that inflation has been ripping. Again, it's not showing in the CPI. A lot of people question, how accurate that is. I've gone over this time and time again and showed you each and every commodity, just about every single commodity, whether it's crude oil, copper, wheat, corn, soybeans, coffee, all flying over the last year. Oil, of course, is going to have an impact, on everything else. And so what this is this is the market in which the bond market's usually right. Of the two, and you talk to people that have done this a long time, background on Wall Street, the bond market's usually smarter, more accurate in predicting where the economy is going than the stock market is. Stock market is full of, driven by usually fear and greed. And right now there's a greed trade going on, a fear of missing out. Anyways, this is telling us something. And at the very least, it's telling us, showing that the market's expecting inflation down the road and higher rates. Now, forget about all that I just said. More important than that is there's an age-old relationship between interest rates and the stock market. And, before Powell, you had Bernanke running the ship, or actually, what's her name? Yellen, and then before that was Bernanke, who started taking things down during the financial crisis. And the Fed made, they didn't try to hide the fact that they, brought interest rates down to the floor to steer money out of safe haven bonds and CDs at the bank and force it into the stock market to buoy the stock market, which then buoys consumer confidence. So that was part of their plan, among other reasons for lowering rates, and it worked. But what happens now, and what is happening, and this is the big thing here, is rates have shot back up. And it's hard to say. You cannot say at which point it's going to be that. It's not a all or none point where money moves all of a sudden out of stocks into treasuries, but it is incremental. There are investors out there, whether they're retail investors, those in retirement or close to retirement, that want to lock in gains on their stock portfolio and reduce their risk. So what happens is the higher rates go, the more money starts moving out of risky assets such as stocks into safe haven treasuries. Nobody wants to lock their money up into a 30-year treasury bond at 2%, but more and more people might want to do it when it's 3, 4, 5, 6%. So the higher rates go, long-term rates, and the same thing holds true for the 10-year and 5 years, and this will trickle down to CDs and everything else. Not the short-term, but yeah, your 5-year CDs and all that, when you see the 5-year treasury bond and 10-year treasury bond going up. So I wanted to say that, and this is something that's going to give the stock market a headwind. Sooner or later, we're either going to have treasury yields come back in or stabilize or stop going up. But if this continues going up, then that's not going to be good for the stock market. The Fed is going to have a problem here. In fact, I think they probably already have a little problem that they're trying to hope that this just doesn't continue on. So I just wanted to point that out. And from a charting perspective, you can see there's a little more upside before the next resistance on TY or TNX. Again, this is a 10-year yield resistance coming up here, and I think the same target. We don't have to hit that level. We do have TYX at resistance, and I think that's we're going to get a pullback, and that would be your target on the 10-year. Usually, if you get the call right on interest rates, you're going to make more on trading the long bond, the 20 and 30-year treasuries, than you will in the 10-year, because they're more rate sensitive. They move more in price depending on changes in interest rates. And there's the other thing to watch too, are your corporate bonds. This is LQD. These are investment grade bonds, and they peaked out here with a divergent high and have been moving sharply lower lately. And yeah, that is a big function of yields going up as well. These bonds are going to be rate sensitive also, but they're also credit quality sensitive, and not always a good sign when you see corporate bonds prices falling. That could be indicative. Remember, the bond market of the two, I believe, are the smartest money, smarter than the stock market. A lot of very smart people, professionals that are in this market. Whereas the stock market, you have a lot of people that have no idea what they're doing, and then everybody in between. But not many people. I know last time you were at the, getting your hair cut, and your barber told you, or your hairdresser, that she's, long, the 10-year treasury, or, it's usually not that way. So this is of concern right here, especially knowing the Fed supporting this market. That's one thing they did when COVID hit. They invoked emergency charters that allowed them to directly come in and buy investment grade bonds, especially those of the low end, triple B, on the verge, or those bonds that just left that credit quality rating, were downgraded from, if you're triple B or above, your investment grade. Anything double B or lower, it's considered a junk bond, below investment grade. But there it is. You broke that support at 134.55, and corporates have been moving lower. And again, that should be concerning, somewhat concerning for the stock market. And of course, something to watch. If they stabilize here and rally back up, I'll just have to address it at the time, because that could also be a flight to safety bid. Because again, I'm looking for a pop in treasuries if the stock market drops. But if the stock market drops and you see LQD dropping as well, that's not going to be a good sign. All right, and let's just look at crude oil, CL, crude futures. You can, of course, trade any of the ETNs. There's plenty of them out there. USO is one of the more liquid ones, and there's some that are inverse oil or leveraged and all that stuff. But these are the futures. You trade, almost around the clock. So there's a lot more I can see in this chart, levels that we can watch. And so as covered recently, we hit the bottom of my second target zone right here, bounced, and we're a little bit above the top of the first target zone. It is not hard resistance, but that's where we're at. In fact, if you look at this closely, I'd add a line right here. We have some resistance going back to this reaction high, and to quite a few reactions there. So this is a pretty good level. I should add that line. I should have had it on my chart before. Try to lift that line up. There it is. All right, and I'll show you why I added that. Here you have, again, a reaction high, reaction from below, another couple reactions there, and that's about where we're at now. So I believe this is likely the first leg down. It's a little big to be a bear flag, but it's similar because a bear flag consists of an impulsive leg down, and then your bear flag, which is a consolidation that takes a slightly upward, shape of a flag, typically on lower volume. And if that's going to be the case, we're about pushing the symmetry of that, or the size for the flag relative to the flagpole. So again, the day is almost over. So what would happen is, and we'd probably need to see it, if this is a bear flag, it'll be next week early, probably on Monday, maybe even Sunday night when the futures open, to see us shoot down. And then your sell signal is going to be a break, technically below the flag if you draw a flag like that, but you want to see this low from yesterday, or I think it was yesterday, get undercut. And then that would take us down probably to my next target, which I gave you on this 6-month 2-hour chart. And that's right here. Again, that just lets me zoom out a little farther. And you can see a long-term uptrend line that comes back here around October or so. And, several reactions along the way. Right there, and then we broke it. And the fact that we broke it helps to validate it. Then when we broke it, we didn't just kind of meander around. It was impulsive selling. And then that is the zooming out here. That's that T2 zone right there that we hit. And you can see if we head down, I have my next target or support, potential target at 57.25. And then if we take that out, and again, I'll just have to see how things look next week. Maybe this is it. Maybe that was it. And we go on and back test. If we do rally, by the way, guys, there's big resistance. So if you're looking, if you're long crude right now, you covered on T2, reverse to a long position. Big resistance up here about 63.55. You're going to have the if we rally there soon, because that would be both a back test of the primary uptrend line as well as that key 63.55 support. And that's where I gave you the sell signal if and when that was taken out, which it was, and that's where the waterfall selling started. So big level overhead, just about another 2 points on crude if it does rally, and that would make for an objective short next week, or an objective place to exit any longs that you might have taken when T2 was hit. Okay, and then we'll look at gold real quick. GLD, on the daily chart, it's nothing big to report, nothing new really. We hit this. I'm waiting for my lines to load. There they are. We hit my bottom of my buy zone, solid support, bounced up so far. Work to be done. 60-minute chart still looks good. I still very much like it, and again, you don't put all your eggs in one basket, but that one I think I like it for both a potential long-term trend trade, re-entry to long-term swing position or trend position, aka investment for a potential move to new highs, as well as just a place to have some money right now, based on my outlook in the market, because I think we'll continue to see gold benefit if there's weakness in the equity markets, as there has been so far. So there it is. It's very simple. We're in a near-term uptrend. There's gold making lower or higher highs, and higher highs and higher lows so far. So there's your near-term uptrend. And that was the catalyst there. On the 60-minute chart, you had positive divergence and a bullish falling wedge, and then you broke out and you took out that 1706. So first resistance is still that 1757 level. We came close enough right there, hit it once. So I suspect if we get there again, we could probably pop on through it and rally up to my next target about 1824. If it goes the other way, if the stock market rallies next week, and depending on what the dollar and the euro do, if we pull back, this is support right here at 1706 or so. And if that goes, that's not going to be good. So I want to see, I'd ideally want to see gold remain above that level. If it gets there, I'll post an update and give you my thoughts. And then on a related note, gold goes up, GDX usually follows, and that's been the case so far. We had GDX at this nice support right there, about $31. Positive divergence, everything I like to see to go long. Bullish divergence at support and oversold to boot. Just three reasons right there to go long gold or GDX and gold. And then a breakout above the downtrend line, the bearish falling wedge pattern, and we rallied up to that 34.50-ish resistance, and so we need to clear that. If we can pop that, then that should open the door to the next target up there, about 37.50 or so. All right, let's wrap it up here. And we'll pick it up next week, see where we're at, and I'm going to continue to focus on these handful of trades right now. I like them because it's diversification among different asset classes. You have commodities, gold, and oil. Then you have gold. You have the stock market. You have gold mining stocks, things like that. And then there's other ancillary related trades like the UGA gave you. That's if the crude goes on to hit that next downside target, which I suspect. And I did an update on this yesterday. I think this is just probably a kickback rally in UGA. That was a big sell signal. That's nice. Two red candles. The breakdown candle on Wednesday, followed by an impulsive candle yesterday, and what appears to be bear flagging action. When you zoom down here on the 60-minute chart of UGA, there's our trend line right there. Price channel, really. You can see that we were in, and you zoom in a little tighter, and what I see is an impulsive leg down, i.e. a flagpole. When you maybe go from this level here, there's a nice little bear flag looking pattern. So if Monday we come down, we gap down or open flat, doesn't matter around where we are, but then start to move impulsively lower, break of that flag would technically be your sell signal. And the way bear flags patterns work is you take the flagpole, measure down to the bottom of the flag, and then add that to the top of the flag, and that gives your measured targets. That would take UGA all the way down here, somewhere around the 2850 level. Some resistance there, and probably take us down to my 2720 target. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.